Over the last 7 weeks, Finweek has been running a series on the 7 deadly sins committed by small business owners. In studio today, we have author Thayn Niemand, who's going to take us through these deadly sins and why entrepreneurs need to pay attention to them. Joining us to discuss this is, of course, Thayn Niemand from Galileo Capital and Gareth Ochse from valuationup.com. Gentlemen, thank you so much for joining us. Now, let's start with the first deadly sin, which is ignoring the numbers. Now, how easy is it for an entrepreneur, and I'm going to throw this straight at you, how easy is it for an entrepreneur to accept that the numbers are saying get out, especially when you have now given up everything and you've dedicated your life to this one particular venture?
Super, it's very difficult. Very often we have to say to entrepreneurs, when the horse is dead, you have to get off. So we, as South African entrepreneurs, we like to push to the nth degree. But there does come a time when we have to say, this is enough. But it is very difficult for the South African entrepreneur to give up.
Tanisisa, would you say that this is perhaps one of the reasons why we see such a high failure rate of small businesses, because we look at the numbers and we just don't want to believe and accept what the numbers are saying, and so you continue with the venture that perhaps is not sustainable?
Look, I mean, you're right. There are those statistics that every small businesses last 2 years or 3 years. And I think, ignoring the numbers is definitely one of the most significant reasons that lead to that. I think as entrepreneurs or small business owners, we get too excited about seeing the big numbers. Now, when we don't see the big numbers and we get too impatient to get all the fundamentals right, to get all the fundamentals in place, to be able to get to those big numbers. And as such, if we don't, because of the excitement, because of the inspiration to get to those numbers, we actually forgo to cross the T's and actually dot the I's. And we only realize at the end of the runway that actually, oh, this is not going to work. And, and you're right, and I think sometimes we just ride it till the end, forgetting to look behind. And I think that the other problem is we just don't want to ask for help. We think that it's my business, I'll do it my way. If I go and speak to Gareth, he is going to give me some, textbook lecture. I don't need all of that. I'll run my business the way I want to, and I started it, I'm going to see through.
But there's one of the issues around that is actually financial education. We hate dealing with numbers. But I believe we should love what the numbers tell us, even if you don't like the numbers, but at least know what they're telling you.
Gareth, let me bring you in here. I mean, on the one hand, we're discussing this element of weakness or perceived weakness that people might be afraid of. But I want to start from the point of a strategy. Do entrepreneurs actually take the time, realistically now, to sit down, formulate a financial management strategy before they go into business? And is that the right way to do things in the first place?
Right. I can't answer the second question because there's a lot of ways of being an entrepreneur. But the key thing for me about numbers is that the starting point of that is people have to have them. So a lot of entrepreneurs I know don't have the numbers to start with. So they operate in very much a vacuum. And then when they get the numbers, they don't know how to use them or interpret them. Typically, they don't reach out for advice. And because of that, they don't know what the numbers are telling them. I don't think you can run a business entirely by the numbers, but you have to have these metrics and you have to know what they mean.
But then we're always told that you need to be persistent and you need to keep on going when times are tough. So at what point do you decide to throw in the towel? I mean, you don't want to do it too early and close something down, which does have promise. So where do you find that balance? Very
often you find a startup for the first 6 months will do very well. And then they start to relax, and then you find is that trend, that downward trend, where it eventually ends, I've got to now go and borrow money from family, friends and fools, or go to the bank and ask for a business plan. And ideally, you would have your business plan in place so that you don't get to that point. But I think when you're doing a consistent financial loss and you're starting to put money into a black hole where it's no return, then it's time to rethink your whole strategy and go back to Gareth's strategy planning that he talks about.
Yes,
so yeah, we worry a lot about a bankruptcy predictor. So it's possible to look at numbers and reliably predict whether a business is going to go under or not. And that's not very good news for a lot of entrepreneurs because they see this number. It's called the Ultimate Z score. It's a publicly available formula. You can look it up on Wikipedia and so on. But if you run the numbers and your score for a privately held company is below 1.23, there's an 80 to 90% chance that you are dead within 12 months. So
Sure.
if my business was looking like that, I would probably, sorry Jess, I would probably pull the plug, or at least pull the stick and try and get out of that death spiral.
Thayn, before I let you go, I think let's move on to the second one, because there's a whole 6 more deadly sins to go through, right? So the second deadly sin is flying on autopilot. So very quickly, Thayn, give us an indication of what you mean by that, and then we'll come back to Thayn.
What I mean by that is very often, because we are so fixated with costs and we don't want to employ somebody, so we tend to do everything ourselves as entrepreneurs. So you are a 1,000 Rand an hour person, but you're sitting in the middle of the night doing work that you could outsource for 150 Rand an hour. So there comes a time where you need to actually get someone in to help you to expand that business, to take it to the next level.
There was a great quote in your article to describe that. I think you called it stamping on ants when you need to feed the elephant.
Correct.
One ant.
Now, a large part of that as well is also about developing systems and processes,
Yes.
I would assume. Now, talk me through, maybe come to you, Gareth, with this one. Talk me through, how should entrepreneurs get to a point when they not only have established systems and processes, but they get to a point where they document them. Why are they not getting to that stage of documenting those systems?
The fundamental reason in my experience is that entrepreneurs do not think of their business as an independent investment that they're making. So if you think about it, I've met entrepreneurs who have millions of rands invested in their business, probably 90% of their wealth sits in their business, yet the thing that they manage every day is a 10,000 Rand stock market portfolio.
Right.
They go back, they look at it, they track how it's doing, they don't do the same thing for their business. So the first thing towards that question is they actually have to treat their business like an investment and start managing it as such.
Third deadly sin.
Yes.
Third deadly sin. I'm going to move right on ahead, which is an unroadworthy business. Now, to a large extent, then I get the understanding this is also about having unroadworthy drivers in behind the wheel. I'm trying to understand how isolated is this from just personal character traits that just if you're not an honest, transparent person, there's not much that can be done about that.
What I mean by an unroadworthy business is that every business that wants to take itself to the next level has to register with the receiver of revenue, has to register with the workman's compensation, and all those statutory requirements that we so much hate to do. But then we want to apply for tax clearance because our client needs a tax clearance and we can't get it. So from that perspective, what we tend to do, there's 2 reasons for that. One is it's just we don't know. Second is we don't care, because it's about cash flow. If I've got to pay my unemployment insurance fund this month, where am I going to get the cash from that? So we leave it, and that's where the unroadworthy situation comes.
Is it a case of not wanting to do these things because of the time that's involved in actually getting them done? Or is it the case of thinking this is going to cost me money to do it?
It's both. And mostly, though, in my experience over the last few years, it's going to cost me money. So it's like VAT. We register for VAT and we collect the money, and when the 2 months is up and we've actually got to take out money out of our pocket and hand it over the receiver of revenue, our pockets get long and our arms get short. So it's about cash flow, and that's why it's so important to check the cash flow as well.
I want to come to Gareth with the 4th deadly sin, which is copycat pricing that can often lead to cash flow dead ducks. Now, how tempting is it for an entrepreneur to look around at the market, find their competitor, look at their price and decide that they're going to then underprice as a way of gaining entry into the market? Isn't this what most entrepreneurs would do?
It's a crucial mistake. So as soon as you copycat pricing, you're telling the market that you're a commodity. And the objective of any business is not to be a commodity. You want to be something different. So the route to copycat pricing is not understanding what the value that you uniquely bring to your consumer. And as a result of that, the only way you get the sale is you price the same or below perceived competitors. Far better to step back, work really strongly on your unique selling point, your unique value proposition, and go back to the market with that, and then price yourself at a premium because you've identified a specific niche that wants your stuff.
Let's talk about that step back that Gareth proposes. How easy is it for an entrepreneur to realize they've obviously adopted the wrong pricing model, to reflect and review on that and decide that, okay, instead of $3.99, I'm actually going to charge the premium of $7.99. Does it make logical sense, and does it happen in the mind of the entrepreneur?
going back to the education side, if you know how to calculate your gross profit must be able to sustain your expenses on a monthly basis. So by doing that calculation, and if you can't find it, you can Google it, you can go to the textbooks and find out how to do the calculation. If you do that calculation, you will see immediately whether your pricing is incorrect or correct. And I like the idea of Gareth saying that create yourself a unique selling proposition, because it's not about price very often in the small business space. It's about the value that you add. So if I'm adding value, I should be able to charge a little bit more.
And it's perhaps taking that extra time to make sure that what you add is of high quality and valuable, instead of going for the quick sell and the quick cash.
100% correct.
Deadly sin number 5. Okay, flying solo for too long. I mean, I think we touched on this a little bit about that fear of letting go. But again, in the way you've written the article, you talk about the importance of measuring efficiency and productivity, and that being at the epicenter of that decision. Do entrepreneurs think in those logical terms? Do they look at themselves as a unit of efficiency and trying to measure that against their staff complement?
I think they do, Nasipo, but I don't think they have got the confidence very often to take that step to employ that extra staff member, to free up their time and do the things that they are experts in. And one of the very simple tests is my lead time being extended? I used to do this job in 3 days, I'm now doing it in 4 days. That to me is a crucial sign of it's time to get someone in to help you.
Oftentimes we also hear, Gareth, that, you know, I think there's this misunderstanding that expansion is a sign of success as well. So how do you strike the balance where you're not hiring for the sake of being big, but you're hiring for the sake of efficiency? Do we find that there's a grey line there at all?
Sure. To businesses that grow top and bottom line are very rare. So, I mean, there literally are probably 5% of businesses out there that are successful that even manage to do those kind of things. So it's a huge decision, the growth decision. And for many entrepreneurs, you get to the sort of modus of operating as a small business, as effectively a mom and pop shop. And you've got to make that decision to employ, to put in systems, to hire people. You've got to trust that these people can do things. You've got to trust that you can identify when they're not and fire them or retrain them. It's a huge change of status of the business and the mindset of the entrepreneur.
And if you're a control freak, it's just
Dedication.
I wouldn't know.
Of course, now you've also used that terrible F word, which is firing, right? Yeah. And let me come to you, Thayn. You know, the deadly sin number 6, which is, you know, playing ugly on the playground. And this really comes down to navigating your way around the labor laws. As a small business or medium-sized business starting up, not even yet expanding, oftentimes, you know, you would find entrepreneurs would bemoan this as extra red tape and inflexible labor laws. But the case of the matter is there's nothing you can do about it. You have to work within that framework. So what is your advice to entrepreneurs who have to hire people and might have to find their way around staff that maybe aren't efficient?
Very simple. Pick up the phone and speak to the Department of Labour or speak to the CCMA. There are, as much as we think it's a government or quasi-government department, they're actually very helpful and they will guide you in the right direction. But think of the downside. If you just go ahead and do something and you are found to be wanting, 12 months of salary might be what you have to pay your unfairly dismissed employee.
Would you say that, would you concur with Thayn's sentiments around navigating the labor law environment?
Yeah, I've never had to speak to the CCMA, but I'm sure it'll happen. But my view has been you've got to take a decision to get rid of people. Yeah. You've got to set performance criteria in place, and you cannot tolerate dishonesty or fraud of any kind. So it's about rigor in your employment contracts. It's about rigor in your recruiting process. So you'd be surprised how few people do background checks or actually do reference checks on a person. That will eliminate stuff. But then when you do have a bad apple, you have to get rid of them as quickly as you can. Even if that means you're paying them 1 or 2 months' salary to sit on the bench while you sort the law out. Get rid of them.
It just seems, listening to your insights, that the problem with entrepreneurs in this country and a lot of SMMEs is that people aren't really doing their homework and they're not going in knowing what it really takes to succeed running a small business and staying within the regulations.
Just it's very, with respect, it's very easy to start a business. It's very difficult to take it to the next level and make sure that you roadworthy, as it were. So, and some of us are called accidental entrepreneurs. We're actually forced to be there. You know, we don't really want to be there, but the only way we're going to put food on the table is by creating some sort of a business. So we're not really educated as to take it and expand it and take it to that next level.
Yes,
The other thing is, I don't think any entrepreneur I know would start the business they're in if they knew how hard it's going to be.
Right.
So the naivety is actually pretty useful because we try stuff.
Yeah.
Right? If I knew how hard my last few years would have been, I would never have started this stuff. But it's been a huge joy, you know, like, and that's a common thread.
That's a common thread that leads us to the last deadly sin, which is contravening the cash flow code. I mean, when you wrote this, then I think you also had this idea of sustainability at the forefront. You know, to what extent are entrepreneurs not projecting forward and looking at the sustainability of their business and just thinking, well, I've got money in the till, so it must all be good?
Do you know, Nasipo, I don't want to use a percentage, but a vast majority of small business owners don't know what their bottom line is. As long as they've got money in the bank, they carry on regardless. And there's nothing wrong with that. And I'm a great proponent of monitoring your cash flow. But as soon as you want to expand your business, the guys are going to ask you questions like, what is your gross profit? What is your net profit? What is your break even? And all those things we don't know because we've just been focusing on our cash flow. A huge number of entrepreneurs cannot produce up-to-date financial statements for their business.
Of course, Gareth, you know, cash flow must be one indicator, at least, that you need to look at for the health of your business. Very quickly, what would the other indicators be?
So we look at businesses in 3 time frames. So in the short term, we look at quick and current ratios, or 2 liquidity ratios. We also look at how much free cash flow, a slightly different measure of cash flow, is generated in the next 12 months. Then in the medium term, we look at the bankruptcy predictor, the Altman Z score I talked about in future, and we look at the business's sustainable growth rate. In the long term, the only thing that really matters is whether the business is reducing risk and increasing its valuation. So there you worry about a discounted cash flow valuation as the long-term metric. And the challenge for an entrepreneur is to allocate resources across short, medium, and long term and understand the trade-offs there.
Now, Gareth, talking to you is probably one of the ways to get one's ducks in a row as an entrepreneur. But, I mean, a lot of what we've been talking about revolves around costs, cash flow, money, numbers.
Yeah.
You know, what is the best way for those entrepreneurs to understand the Z scores, to understand the bankruptcy predictors, if they're simply just an entrepreneur? Because as an entrepreneur, I'm an IT entrepreneur, and that's all I know. Now, when it comes to Z scores, when it comes to cash flows, you know, I'm simply in the dark. What is the best way for me to acquaint myself, to understand these things? I mean, you know, probably going to school is not even in the books because I have to run. I mean, I have a business to run. What is the best way to understand this?
It's a horribly shameless punt, but Finweek does a very good job. So we have a column in Finweek that's run for over a year, and if you read back the editions, it talks to every single one of those points. And if that isn't enough, then there's Google, and there's your financial advisor or your accountant. Well, you know.
Very quickly now, Thayn, before I let you go, you spoke about financial reviews, and I'm sure businesses are different, and so you'll be reviewing at different times. But is there a golden rule that you should be applying when it comes to financial reviewing?
In the first 6 months, review on a weekly basis, thereafter at least every quarter.